I've never asked for a meeting with any president, and I never will.
I could call him for a meeting, but it's like talking to a wall.
Imagine a high-stakes game of chess where every move shakes the global economy. The latest showdown has been between President Donald Trump and Federal Reserve Chair Jerome Powell. Let's unpack the drama, the data, and the serious financial stakes behind this clash. We'll explore exactly how it could redefine America's economic landscape for years to come, what all this could mean for your hard-earned investments, and what you can do about it. Coming up. Welcome back. My name is Steven Spicer, and it's my goal to help you invest smarter. And part of that is trying to make sense of the chaos that's out there. I've spent the last 15 years dedicated to just that, and identifying the best ways to thrive despite the chaos. Well, in recent weeks, some of that chaos has come from President Donald Trump dialing up his criticism of Fed Chair Jerome Powell to unprecedented levels. Trump has publicly demanded aggressive cuts to interest rates, accusing Powell of choking off economic growth. The climax came when President Trump declared Powell's termination cannot come fast enough. Although Trump quickly walked back the implication he'd fire Powell before his term ends in May of next year, markets don't as easily shrug off statements like that. And perception in the market often becomes economic reality. And let's be clear, Trump's friction with Powell isn't a new phenomenon. Even though Trump himself nominated Powell in 2017, their relationship quickly deteriorated once Powell began raising rates in 2018 and 2019. At the time, Trump famously labeled Powell as clueless and repeatedly blamed Fed policy for sluggish market performance. Today, history is repeating itself, only this time, the stakes feel even higher. Trump's recent comments aren't simply rhetoric. They're already having tangible effects. Following Trump's renewed attacks, investors rushed to dump U.S. Treasury bonds, pushing yields dramatically upwards. Specifically, the 10-year Treasury yield surged past 4.4%, levels not consistently seen since right before the Great Recession. Remember, bond yields move inversely to prices, so a spike in yields indicates investors selling bonds due to rising uncertainty about U.S. monetary policy. The rise in yields matters profoundly, not just to financial markets, but also to everyday Americans. Mortgage rates are directly tied to 10-year Treasury yields, and now we've seen the average 30-year mortgage rate surpass 8%. Creating serious affordability problems for millions of Americans. This marks the highest mortgage interest rates since the early 2000s, causing home sales to drop sharply, over 18% year over year, according to recent data from the National Association of Realtors. High borrowing costs don't stop at mortgages. Auto loan rates, small business lending, and even credit card interest rates are all trending upward, weighing heavily on consumers and small businesses alike. At the core of Trump's complaint lies a fundamental economic debate. Trump believes lower interest rates would turbocharge economic growth, reducing borrowing costs for businesses and making the stock market soar. However, Powell counters that aggressive rate cuts now, especially with core inflation still hovering stubbornly over 3%, significantly above the Fed's admittedly arbitrary 2% goal, could dangerously reignite inflation, forcing even harsher economic medicine down the road. We'll talk more about the real impact of inflation here in a second. But yeah, so what's the historical track record say? Independent central banks consistently outperform politically influenced ones when it comes to economic stability. According to research by the International Monetary Fund, the IMF, countries with politically independent central banks have, on average, about 3.5 percentage points lower inflation than those with political meddling. In contrast, central banks that face political interference, seen clearly in places like Turkey, Argentina, or Venezuela, frequently grapple with hyperinflation, sharp currency depreciation, and chronic economic instability. And that's precisely the risk at hand. By pressuring Powell, Trump risks eroding the financial reserve's historic independence, potentially setting America down a perilous path. Markets worldwide rely heavily on the predictability of U.S. monetary policy. The U.S. dollar remains the world's reserve currency, at least for now, precisely because investors like to believe the Fed makes decisions based on data, not political expediency. If investors believe the Fed has lost autonomy, more so than they already do think that, global capital could flow elsewhere, weakening American economic dominance and possibly strengthening alternatives, be they other currencies, gold, commodities, or digital assets. Trump's push also stirs speculation about Powell's potential successor. While Powell's current term lasts until May 2026, markets often begin pricing in the likelihood of a shadow Fed chair, a future leader with different economic philosophies, well before a formal appointment occurs. Names currently in circulation, like former Fed Governor Kevin Warsh and economist Kevin Hassett, signal Trump's preference for candidates likely to adopt a far looser monetary stance. Such a scenario could create uncertainty in financial markets well ahead of any formal transition of power. It's also important to contextualize this battle in the broader economic landscape. The current U.S. economy is walking a tightrope. Unemployment remains historically low, around 3.9%. Consumer spending, long the engine of U.S. growth, is slowing significantly, and manufacturing data has begun indicating contraction. Corporate earnings growth has moderated considerably, and recent GDP projections have consistently come in below expectations. The Fed itself remains cautious, indicating interest rates may stay higher for longer to ensure inflation doesn't return. While Trump insists aggressive rate cuts could unleash economic growth and bolster his political position, Powell's cautious stance aims at protecting long-term stability, even if it means short-term political unpopularity or market pain. Disagreement thus boils down not only to policy specifics, but also to fundamental differences in economic philosophy, prioritizing short-term stimulus versus long-term price stability and economic discipline. Finally, consider investor behavior. Markets hate uncertainty, and the Trump-Powell feud injects plenty of it. In previous Trump-Powell spats, market volatility spiked significantly, like in late 2018, when aggressive Fed criticism combined with rate hikes led to a nearly 20% stock market correction over just a few months. Investors today are justified in their caution, wary of history repeating itself as Trump's rhetoric again targets Powell. Ultimately, this political economic tug-of-war has far-reaching implications. It impacts the cost of borrowing for every American household, the stability of global markets, and the very future of the dollar's dominance. For investors, homeowners, small business owners, and everyday citizens alike, this showdown will impact your life. The fallout from this high-stakes clash could reverberate throughout the global economy for years, if not decades. It's for potential chaos like this that we put together our financial doomsday survival guide. You can learn more about that through the link in the description. As for what Fed manipulated lower interest rates could do to the real inflation rate you and I experience, what would happen if Powell or even the next Fed chair succumbed to Trump's pressure, this amazingly acted playlist will help prepare you.